Today, I'll be breaking down Amazon's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Amazon's growth story is nothing short of remarkable. The company's revenue increased from $88.9 billion in 2014 to $590.7 billion over the last 12 months. One of the key drivers of this growth is Amazon Web Services, or AWS. As businesses worldwide migrated to cloud computing, AWS became a preferred provider due to its robust and scalable infrastructure. AWS is expected to reach $100 billion in revenue by 2024, is the clear frontrunner in the cloud services market, holding a substantial lead with around 32% market share. Amazon's core e-commerce business has also seen substantial growth, both in North America and internationally. Continuous innovation in logistics and delivery capabilities, including investments in fulfillment centers and an expanding air fleet, have enhanced Amazon's ability to offer faster delivery options and improve customer satisfaction. Another key driver was the growth of Amazon Prime. The membership offers numerous benefits such as free shipping, exclusive deals, and streaming services, driving higher customer retention and increased spending per customer. Finally, Amazon's advertising business has been growing rapidly, leveraging vast customer data to offer targeted advertising services, contributing significantly to financial growth. However, Amazon's revenue growth has slowed down over the last 2 years. This can be attributed to several factors. First, the post-pandemic adjustment. The e-commerce boom during the pandemic created a high base, leading to a natural slowdown as things normalized. Second, the economic conditions. Inflation and supply chain disruptions impacted consumer spending and operational costs. Third, increased competition. Competitors like Walmart and Microsoft Azure have intensified the market competition. Finally, regulatory challenges. Increasing regulatory scrutiny in various markets can lead to operational constraints and higher compliance costs. Despite these challenges, Amazon's long-term growth trend is outstanding, increasing more than 563% over the last decade. When it comes to net income growth, Amazon has shown a remarkable increase over the long term. However, during fiscal year 2022, Amazon's profits experienced a significant decline, dropping from $33 billion in fiscal year 2021 to $2.8 billion. This drop can be attributed to several factors. Firstly, there was an increase in operating costs. Amazon faced rising costs due to inflationary pressures, higher wages, and increased logistics and supply chain expenses. Secondly, the investment in Rivian Automotive affected net income. In Q4 2021, Amazon's net income included a significant pre-tax valuation gain from its investment in Rivian Automotive. This was a one-time gain, and fiscal year 2022 did not benefit from this boost, leading to a comparative decline in net income. Thirdly, macroeconomic challenges played a role. Global economic uncertainties, including fluctuations in foreign exchange rates and a challenging retail environment, further strained Amazon's financial performance. The international segment, in particular, saw a decline in sales when adjusted for currency changes. To address these issues, Amazon's management took several recovery measures. First, they implemented various cost reduction initiatives across their fulfillment network to improve efficiency and reduce expenses. This included optimizing logistics, enhancing automation, and negotiating better terms with suppliers. Second, Amazon focused on high-margin segments. The company continued to prioritize growth in high-margin areas like AWS, advertising, and subscription services. Additionally, Amazon expanded its Prime membership benefits and launched new services like Amazon Clinic and RX Pass, aimed at increasing customer loyalty and driving higher recurring revenue with higher margins. Finally, strategic investments in technology and innovation, such as the introduction of new AWS chips such as Graviton 3E and now Graviton 4, and services like Amazon Security Lake and AWS Data Zone, helped Amazon stay competitive and attract more business customers. Concluding this initial dimension, despite facing significantly negative free cash flows of $21.8 billion in 2021 and $31.2 billion in 2022, Amazon managed to regain its long-term growth trajectory with a $25.9 billion figure over the last 12 months. Now, let's shift gears to profitability dimension. Amazon's gross margin has improved significantly from 7% in 2014 to 17.5% in the last 12 months. Similarly, the operating margin has also improved from 0.2% in 2014 to 8% in the last 12 months. Lastly, the return on invested capital reflects the efficient use of capital to generate returns. However, this metric has historically reached higher values than it currently exhibits. Several factors have contributed to a significant increase in Amazon's margins and profitability. Firstly, AWS growth has been a major driver. AWS offers higher profit margins compared to retail operations, and its rapid growth has positively impacted Amazon's overall profitability. Secondly, operational efficiency has improved. Enhanced efficiency in fulfillment centers and logistics operations has reduced costs. Initiatives such as automation and better supply chain management have helped increase margins. Thirdly, the growth in Amazon's advertising business has provided a high-margin revenue stream. Additionally, subscription services have also provided higher margins. The expansion of Prime memberships and other subscription services has led to more stable and predictable revenue with higher margins than the retail business. Finally, economies of scale have played a crucial role. As Amazon continues to grow, it benefits from economies of scale. Larger operations allow for more efficient use of resources and lower per-unit costs, improving overall margins. By focusing on these high-margin areas, Amazon has successfully increased its profit margins, even amidst various economic challenges. Moving on to the solvency dimension. The quick ratio has remained firmly stable around the 0.82 value. Despite the ratio being below 1, this isn't a concern because this formula excludes inventories. Amazon has over $31 billion worth of inventories, most of which can be easily sold due to high demand and efficient inventory management practices. The debt-to-equity ratio has decreased from 1.16 in 2014 to 0.62 in the latest 12 months, indicating a reduction in Amazon's leverage. This decrease occurred despite Amazon's total debt increasing from $12.5 billion in 2014 to $134.7 billion, showcasing the company's ability to manage its equity growth more effectively than its debt expansion. The current debt-to-free cash flow ratio of 5.20 isn't the best. This means that Amazon could pay off all its debt with the cash flows generated in 5.20 years. Ideally, businesses should aim to keep this ratio below 5. Now the important fourth dimension, valuation. The EV-to-sales ratio currently stands at 3.57x, which is relatively high compared to the historical averages. It exceeds the 5-year average of 3.26x and the 10-year average of 3.02x, indicating that the valuation is on the expensive side. Conversely, the current EV to EBITDA multiple is trading significantly below the 5-year and 10-year averages. The price-to-earnings ratio has decreased immensely from its historical highs, but its absolute value still trades at a premium valuation. The fifth and last dimension is the shareholders' return. Since Amazon doesn't pay a dividend, the metrics dividend growth, dividend yield, and payout ratio are naturally rated 1. The number of shares outstanding increased from 9,240 million in 2014 to 10,492 million in the last 12 months, reflecting a 10-year compound annual growth rate of 0.8%. In 2022, Amazon implemented a $10 billion stock buyback program, which reduced the number of shares outstanding by 1.1%. However, the shares outstanding have since risen again due to stock-based compensation. With the increase and consistency in free cash flows, I surely expect new and larger stock buyback programs. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.5. Now let's move on to Amazon's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Amazon's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Amazon stock at $245, representing an upside of 25.8%. The bull case values Amazon stock at $428, representing an upside of 119.3%. Finally, The bear case values Amazon's stock at $119, a downside of 38.9% if Amazon's execution goes south. In summary, Amazon earns an impressive 5D rating of 3.5, with a weighted average price target of $257, implying a 31.6% undervaluation. Amazon is a globally recognized brand that has seen outstanding growth over the past decade. But what about its future drivers and main risks? AWS is a major growth driver, offering high-margin services. Innovations like custom generative AI chips are expected to enhance AWS's value proposition and market share. Secondly, e-commerce and retail innovation. Investments in logistics, supply chain efficiency, and new retail technologies, such as the Fulfillment by Amazon program, are driving incremental operating income and improving customer satisfaction. Another driver is the advertising revenue. Amazon's advertising business is expanding rapidly, leveraging vast customer data for targeted advertising. Finally, Amazon still has a lot of room to grow internationally. Strategic partnerships, acquisitions, and localized marketing efforts are helping Amazon expand into new international markets, capturing a larger share of the global e-commerce market. As the major risks, Amazon will face the challenge of market saturation in established markets and intense competition in the e-commerce and cloud computing sectors. It may also face fluctuating economic conditions and stringent regulatory requirements, especially related to data privacy and antitrust issues. Other major risks could be global supply chain disruptions that can impact Amazon's inventory management and delivery efficiency. Finally, Amazon may also face shifts in consumer preferences. Changes in consumer behavior, such as the increasing demand for sustainable and ethical products, require Amazon to continuously adapt its offerings. By understanding and strategically addressing these growth drivers and risks, we are better equipped to correctly assess Amazon's business. However, our job isn't done yet. Given all these insights, I plan to take a closer look into Amazon's business before making an investment decision. As such, my final verdict is, next round, Analysis 2.0. Don't forget to subscribe to my channel and stay tuned for the next analyses.